Good Fed week, everybody. How's everyone doing? Hi, Ron, Patrick, Kevin, Glenn. Tier, how are you? Valu, how's it going? Blake? Stelios? And hello. Hi, LaShawn, how are you? So we just have one piece of business I'd like to get out of the way, and I'm going to pass it over. Hi, Ash. I'm going to pass it over to Blake. He has some views he wants to share. Good one, Ziggy. It's Steve Volge, alias Stellianus Vulgaridis, his birthday today, or last night.
Happy birthday.
Happy birthday, Steve.
Hey.
Thank you.
Stellianos, happy birthday.
I am on holidays right now, but I had to come in to wish Steve happy birthday and to say hi to everybody. So hello.
Then you could sing along with me. Happy birthday to you. Happy birthday to you. Happy birthday, Steve Volge. Happy birthday to you. He's 37 years old. He's 37 years old. Happy birthday to you, Steve Volge. You're a 37-year-old guru who top-picked the NASDAQ last week. Congratulations. May this be your best year ever in all ways, Steve.
Thank you very much. Good thing that we're not recording and posting those webinars. Oh, shit. I just realized that we do.
Happy birthday, buddy. Anyway.
Happy birthday, Steve.
Thank you, Blake.
Hey, Blake, how are you?
Thank you, Dale.
Good morning. I had to jump in and try to sing a little bit, and then the song, I lost the rest of the song. I couldn't follow along.
I know.
You veered off a little bit.
Yeah, I'm an improviser, buddy.
You are. Happy birthday, Steve.
So what's on the radar, bro?
Thank you.
Bad week.
Actually, here I'll take over first thing, and I want to say, again, happy birthday, Steve. Glad to be part of your life, and happy birthday to you. This is, as you very well pointed out, this is Fed week, so it's going to be an important week for the dollar. One thing that I was just looking at, I was pointing out to some of the guys that I trade with, is just that gold's so weak. Gold just had broken into new lows, but keep in mind we're at pretty important levels here. I mean, this is a 38% retracement. Now we broke an upsloping trend line. You can see it right here, and we cracked through some previous resistance, current support, and it's also 161% extension of this move here. So it was holding up until just moments ago, and then we broke into brief new lows. And silver as well, hit the $17 mark, and silver came under some pressure too. But I don't know how aggressive you want to get being on the short side of the precious metals yet. Just because Wednesday is going to be such a big day with the dollar. Now, the dollar, and this is, the thing that we've noticed about the dollar is we're sitting at the 618 retracement. So on a much longer time frame, we're sitting at the 618, and this is important support for the dollar. I don't have any position in the dollar at this moment, and the dollar it's make it or break it this week, because how the dollar responds here is going to be very important. Assuming everybody believes the Fed's going to raise rates on Wednesday, that is the going assumption. So now there's two questions that have to be asked at this point in time. Is the dollar going to rally because the Fed raised rates once again, which that the likelihood of them raising rates is quite high. So is the dollar going to is the dollar going to rally because they raise rates, or is it priced in? And here's the problem. If it's already priced in, the dollar has a big issue because the dollar just worked off some pretty oversold conditions. And if the Fed raises rates and the dollar goes down, I don't know what's going to stop the dollar from going down a lot further at this point in time. That's like the big issue right now. And how there's another potential that the Fed doesn't raise rates. Now, I don't think that the Fed is going to try to surprise the market. But if the Fed did and did not raise rates, the dollar is going to get completely crushed. So I think the risks are still for a lower dollar at this point. Now, I don't have any dollar exposure. I'm not short any dollars. I'm not long any dollars right now. I know Steve is short the pound, and he picked that thing off really, really well on Friday morning. I believe it was Friday morning. He sold it right here at 127.
It was an early birthday gift from the FX gods, as I had tweeted. Like,
yeah, it really was.
127.70.
You picked that off pretty good, and here's the thing. I don't know even if the dollar does start to fall, if that's even going to help the pound much. I mean, the pound's really, under a lot of pressure, and you can see it with the euro pound. I mean, the euro pound is just ripping, continuing to rip higher, and we're closing in on the 618 retracement. The euro pound looks like it's going to 90 pence, as originally expected. So the pound obviously looks weak, but if the dollar really comes under pressure, following Wednesday, I don't know where the euro is going to go. I mean, the euro looks like it's going to 114. I mean, euro looks like it's going to 114, and if we break 114, we're going to go see 117 really quickly thereafter. Like I said, I don't have any dollar shorts right now, but I'm leaning into that at the moment. I'm looking at it going, maybe I should be shorting some dollars, even though I'm not. I'm not. A couple other things that are standing out to me, for at least right now, is the weakness of the dollar against the Canadian. You notice how the dollar Canadian's walking a very fine line here, and we've here. Let me get rid of these lines are from last week. The dollar Canadian below like 134. Or 133.80 right here. I mean, that's going to take us right to 132. And I look at the dollar Canadian, especially following like the Canadian jobs report, and knowing that the market is still pretty short Canadian dollars. What happens to the dollar Canadian if the dollar falls? I think the dollar Canadian is vulnerable. And like I said, I don't have any dollar Canadian shorts. I was short on Friday, made some money shorting at like 134.70, and I think I covered it like right around here, not too far away from where we're at. I think I made like 20 pips on it being short Friday, 20 or 30. But I look at the dollar Canadian, and I think it's extremely vulnerable at this time. Now there's one thing that there's something that I am in right now, and the position I am in is the Aussie New Zealand, and this is a big week for the Aussie New Zealand. I'm long, a fairly sizable position. I exited a little bit this morning right around here just to take some off the table, because when you're up 40 or 50 pips just in a day on this pair, it doesn't hurt to take profits, especially when I know it's going to be a big week. When I say I know it's going to be a big week, we have on, is it Tuesday or Wednesday? Hold on. It is Wednesday as well. We have New Zealand GDP, okay, which the market is looking for a beat in New Zealand GDP. And then we have Australian employment data, which the market is expecting a weaker employment report than last month. Now that all happens after the FOMC. The reason why this is a big deal, because the Aussie New Zealand, I think, is very your risk is very manageable from here. Look, the risk is below 104, any which way you slice it. I know you guys, we've talked a lot about this pair in the last week and a half, and I basically bought it. My cost average is a 104.50, and I'm sitting in it, and I bought it because I know the risk is below 104. But what's your reward here? You know, risk below 104, your reward is maybe 106, which is previous support here, 107, 109, 110, 111. If you get my drift, the risk is manageable, meaning the risk is just down here below 104, but your upside reward could be somewhere way up here. Anywhere from 106, here, let me grab my pen. Or here, let's do it this way. Your reward could be up here to somewhere up here. So your reward, your risk is here, you know, you're currently here. Your risk is here, your reward is from here to here, maybe even further, who knows. But the reason why this week is a big deal, because the market is already expecting a strong New Zealand number. The market is already expecting a weaker Australian number, which leads, you know, has led to Aussie New Zealand weakness. So how about if those numbers come in opposite of what the market is expecting? Meaning, how about if the New Zealand number misses expectations slightly? How about if the Australian number beats expectations slightly? We will be trading at 106 by the end of the week. So, you know, that for me, it still makes sense to be long. Now, I'm not long as much as I was, but I still have a very sizable position. And again, I know my risk. Anything that we do in the markets, any trades that we make in the market, the only thing we can really manage and control is how much risk we're taking. You know, I can't control what the economic data is going to be. I can't control how the, you know, how the market is going to react. I can control what my risk is, and if my risk is manageable, and in, you know, from a ratio perspective, I can outpace my reward multiples of my risk. That is the best trade I can get myself into, and that is what I'm seeing here. And that's why, like, look, I'm willing to risk below 104 to potentially make, you know, 150, 200, 300, 400 pips. I'll do that every single time. You know, risk 50 pips to make 100, risk 50 pips to make 200, risk 50 pips to make 300. That, as long as the macro makes sense, then I'll do it. And in this case, it does. And that's like, this is the only position I'm really in right now. So, and that's why I'm doing what I'm doing. And I could be wrong. There's no doubt I can be wrong. But again, it's managed. I know where my risk is. I know where I have to pull the plug. I know where I get stopped out. That's it. It's end of story. So that, you know, and that also, to me, avoids the risk of the FOMC this week, which, by the way, is again, it's a wild card. I don't know what to do. I don't know what's going to happen with the FOMC, Dale. And I'd like to believe that the Fed's going to raise rates, but sorry, I'm readjusting. I got some pretty good sleep this weekend, so apparently I wanted to sleep a little bit more today. But I got, as I said, I think the Fed's going to raise rates, but the scary thing about the dollar is it might be factored in, and that's why the dollar might be vulnerable a little bit later on this week. But that's what I'm looking at now. And also, you know, as you guys know, the S&P, when we talked about this in the week ahead video, and I hope all you guys have been watching that, we had an outside day. We had an outside day on Friday, and I am looking to short the S&P today. I was short some coming into this week. I closed it out this morning in Europe. So I was short, you know, going into today. I already closed it. I'm actually looking for a little bit of a rally here to sell into. So, you know, I'm actually looking for, you know, a rally maybe up to 12 or 24.30 to sell. some S&P, something like that. I don't know if I'm going to get it though. That's the thing. I don't know if the S&P is going to give me the opportunity to short it up here. I'd like to believe it will, and I'd like to be a seller somewhere up here in this neighborhood. I just don't know if it's going to happen. But that's my plan with the S&P right now. And if you guys don't trade, if you don't trade equities, you should be paying attention to them, especially based on the price action that we saw on Friday, and especially based on the liquidation, the mass liquidation that we saw in the FANG stocks, which is Facebook, Amazon, Netflix, Google, Apple, you know, FANG. Those stocks saw mass liquidation on Friday, and whenever you see those high beta names, you know, get pummeled like that, that is a big risk to the market, because there's so much overweighting in long Apple, long Amazon, long Facebook. Those are the high beta. When the people expect the markets to go up, they're going to be buying those names, and when those names start to come under pressure, that really puts in question the current rally that we're seeing in the equity markets. And that means a lot to us as currency traders, because if those stocks come under pressure, that means we might get some risk aversion. And if we see some risk aversion in the market, what is the ramifications in the FX market? Well, the FX market might be more yen strength. I don't know how the dollar is going to react, but more yen strength. We might actually see gold strength come in. And, you know, some of these yen pairs like the pound yen. Oh, by the way, speaking of the pound yen is at channel support. Here, let me get rid of this really quick. We're at channel support here in the pound yen. More importantly, we're like almost on the 200-day moving average and trend line support here. Dude, look at this pound yen. I mean, if this pound yen really breaks like 139, 138.70, which is the 200-day moving average, we could see a pretty big liquidation of the pound yen. That's ugly. This is not a pretty chart. And think about that. I mean, if stocks come under pressure and the pound's already under pressure, the pound yen could really, you know, I mean, we could see like the low 130s again. We could see 135, 132, 120. We could see levels like this in the pound yen. And again, you know, just keeping in mind that the stock market looks vulnerable as well. Well, so does the pound yen, because you already see how weak the pound is almost across the board. So, so those are the things that I'm looking at today. And
still short Kiwi yen, Blake?
No, Actually, no. I'm glad you brought that up. I was talking to the guys that I chat with. I closed it out right here at 79.10. Actually, literally like right here. But I have an order to sell back below 79. So in other words, I'm looking for a breakdown, because we had this false breakout up here. I'm looking for a breakdown below 79 to get short again. So I know if I closed it on this trend line, you can see how we're on this upward sloping trend line. If we get below 79, it's probably going to see 78 and change. This one is one of those that I'd like to get short the New Zealand yen ahead of Wednesday as well, because if New Zealand, you know, GDP misses, this New Zealand yen is set up for a nice move lower. No, but I was short at 58.
Yeah, near the high.
Yeah, somewhere up here, and I closed it this morning right at 79.10. But I'm already out. But I am looking to reshort it again. So yeah, this one definitely added to my P&L overnight. So yeah, that's what I'm doing, and that's what I'm thinking right now. And I don't know if was there anything, Dale, you were looking at in particular?
I like the EuroCAD. That Steve and I have been talking about, and then on the S&P, I like Grega's count, and it lines up with a monthly off number I have in the S&Ps. Sometime this month, I expect 2370, because that would be the 2-month reversal in the S&Ps. So that's a number that popped up, and the EuroCAD how the ending diagonal looks pretty weak, and again, you have risk manage if it negates a ending diagonal. It's funny, someone said, well, what's your bias? And I said, well, ending is a pretty good clue. What do you think?
Right.
So that's what I'm looking at. I've been up for 10 hours and
yeah, I saw you chatting in the middle of the night, and I was thinking, what is Dale doing up in the middle of the night? I mean, I was sleeping.
Happens once in a while.
I guess. I guess so. Yeah, but you know, I was speaking of this Euro Canadian, I was short this with the dollar Canadian on Friday, and I shorted it at like, I don't know, like 50, 70 maybe, somewhere around here, and I closed it like 50, 40. I only made like 20 pips. I thought it was actually going to break down, but you know, the euro is outperforming right now. I'm a little nervous shorting the euro because I look at the dollar, and the dollar just looks so vulnerable that I'm just really kind of concerned here. I'm really, you know, as much as I think the Canadian could really rally, I'm a little worried about being short the Euro CAD. You know,
if it makes you feel any better, Blake, we have the exact same entry in Euro CAD. You said you're not in it anymore.
No.
I'm still in it. I'm like 10 pips out of the 15 pips out of the money. And I'm also looking at the same thing. I don't like the fact, you know, that it's not doing something yet.
Yeah, I mean, I have a 150 level that would be an attractive entry. And then you're wrong. And then you're wrong over like the 230 area or close over 52.
But I'm sticking a little bit longer with it personally. You know, I want to monitor how it's going to go the next day or two, and if it doesn't really move or whatever, you know, I might just leave at break even if it gives me the opportunity, or take a minimum loss. We'll see.
Yeah, well, you know, I think it's the dollar Canadian below 134 that will really trigger for me.
That could be it.
To be, you know, short these Canadian pairs or long Canadian dollars, and I'm not quite there. And like I said, I took it off the table for a very minimal gain. Because it was a small position. It wasn't anything like I could write home about. And like I said, I only took off like 20 pips or something like that. But I'm looking at it as, I think it looks like a good short. It looks like it's trying to round a top here. It looks like it's trying to, you know, really fortify some highs. But again, you know,
so it's kind of like the Aussie Kiwi, Blake. I mean, you have you can control the risk. Tried to close over 52 a few times, hasn't been able to. So if that happens, you know, you have to get out of the way, that we could be looking at 54, 55, something like that.
And that's the thing, is you gotta you know, look at it from a, what is your risk, and are you willing to take that risk? You know, so if your risk is above, let's say 152.60 here. Okay, well, it's at 152 or 150.80, so you're risking about 150 pips. And I know a lot of people go, wow, you know, 150 pips or 170 pips, that's a lot of risk. Not really. I mean, if you're risking 170 pips, but you're looking to make 300, you know, it's really not a lot of risk. You just have to make sure that it is within your risk parameters from a money standpoint if you get stopped out. You know, and so I always tell people, look, if you're going to have a wide stop, just take a smaller position. So, like, if you go, oh, well, I'm going to short it at 151, let's just say, I'm using some round numbers here, 151, and I stop out at 152.60, well, you're risking 160 pips. Okay, well, if I sell 100,000 of it, I'm risking, you know, $1,600. And you're like, well, $1,600 out of my $100,000 account is only, you know, it's only 1.6%. I can take on that risk. I mean, I still think that's a little excessive, but, you know, you go, okay, well, I can take that risk. But if you're like, well, I've got $100,000 in my account, and I'm only selling 50,000 worth, and if I get stopped out, I'm only losing $700. Well, it's only 0.7% of your account on your $100,000 account. That's more maybe manageable. You're taking a smaller position here. But you still manage your risk, but you're just taking a smaller position knowing that the stop is going to be wide. And that's how I deal with wider stops. If my stop is going to be wide, which I'm not opposed to taking risk like this, I just know that I have to adjust my position size accordingly so I'm not risking too much of my account on a percentage basis. And that's how I personally attack trades like this, especially when I'm trading some of these cross rates. Is, you know, when I start trading the pound New Zealand or pound Aussie, pound Canadian, euro Canadian, euro Aussie, euro, those currency pairs can move 150 pips intraday. And so you have to think, okay, well, I might be risking 200 pips. Well, what does 200 pips mean to you monetarily wise? If you're risking 20 grand, is that 20 grand within your, you know, your risk parameters? If you're risking $200, is that $200 within your risk parameters? It all depends on how big of an account you trade. And that's when I always say size matters, Dale. Size matters.
I leverage it, you know, yeah, leverage. That kind of size? Yeah,
yes. You got it. Oh no, I was talking about the different size. Yeah. All right. Anyway, Steve, how you doing this morning on your birthday?
I'm doing great, mate. I'm doing great.
Good. What's on your radar today? Because I'm going to be checking out here in a second. I got my son's got my son's got summer school, so I've got it. Not summer school like because my youngest son is going to a new school, so he's got an introductory thing. I got to kind of help out for that this morning, unfortunately. Summer months with kids at home, and both parents are trying to do some business, so I've got to take on a couple of responsibilities. What are you looking at though?
Actually, plenty of things. I'm monitoring the pound, as you've said, since I have a position in that. I'm monitoring NASDAQ for the same reason. I'm monitoring silver, although I bailed out the other half of my position at Friday's close because I didn't like the price action. So I now have booked profits on both halves of my position. I'm monitoring the USD yen because I see a possible descending wedge. I'm monitoring the Kiwi because I have a position there as well, which also troubles me a little bit. I mean, I'm like 25 pips in the money, but I don't like the fact that it still seems strong. Yeah, it still seems strong. It's still holding the ascending channel. But I don't. I mean, since my entry is very, very close to the high, I'm probably sticking with it. I mean, I have very, very little risk on the table. Since my stop loss is in essence like 20 pips, so I'm thinking of sticking with it and see what happens. Although you never know, I may decide otherwise.
I flipped the charts over to you, so you can show your screen what you're looking at.
Sorry, I didn't see because I was looking at another
point. All right, Blake, thanks for leading the show off today, bud.
Hey, no problem. Hey, real quick, Steve, before you continue on, and I'm sure everybody wants to see exactly what you're looking at. I want to mention it because I know. Yes, we guys and gals, we are. Now, this is at the end of July, so July 31st, which will be Monday. We're going to move the webinar an hour earlier, and the reason why we're doing that is because it's going to be probably a better time to do prep work before economic data. So because all the economic data usually happens an hour ago. So we'll be monitoring and doing analysis before a lot of the North American data. So just want to let you know we're going to be moving an hour earlier on July 31st, which is a Monday. And from the people that I've talked to, overwhelmingly everybody says it's going to be a better time for them. So we're giving you guys plenty of heads up. So.
Yeah, it makes it easier for the people in Europe, Blake, and you'd be surprised how many Aussies stay up till midnight to be here.
I know. So I think it's going to be a better time slot for everybody. So anyway, you guys have a great trading session. I will catch you guys tomorrow.
Okay, bro.
Bye-bye, Blake.
Happy birthday, Steve. Happy birthday.
Thank you, mate.
All right.
Thank you, mate.
Bye-bye.
Okay, birthday boy.
Okay, let's see what people want to see. First of all, we didn't speak about it, but that was an excellent development we had on Friday on the NASDAQ. I mean, that was completely unexpected the way the day had started. We were positive in most indices, and then the NASDAQ started rolling over. And you know, when we actually had dropped below the previous day's low, at that point, you know, it looked quite certain that things will unravel. I was quite lucky with it because I was keeping my stop loss. As I had said back some days back at the webinar, above the 127.2 extension, which was at 5,920. To be honest, I had started doubting that this trade is going to work. But on the other hand, I could never, you know, imagine that within one day we would have that kind of a move that we saw, which was just unbelievable.
The biggest range on the chart going back to last July on the way down. You know, Steve, I have a comment about the speed of the move. And I think it speaks, not that it just went down, but I think there was maybe 8 seconds when Amazon lost almost 10% in 8 seconds. So live by the machine, die by the machine. Because you know what? There are no more locals under there to make a market because they made, you know, they took all the incentive away from being a market maker, you know, when they decimalized markets. So this is our new market structure. And, you know, kind of reminded me like a mini flash crash, but you know, if these very liquid, high priced, high participated stocks can do that, and some were saying, well, was it a fat finger? I don't think it was a fat finger because it was broad based. It wasn't just one stock. So
I don't know what it was, but I know that this market was extreme in any sense you looked at it. I had explained plenty of reasons why.
It shows the fragility of it, that in a matter of seconds, all that market cap could be wiped out.
Yes, completely.
So
completely.
That's what my takeaway on that.
And I actually, you remember, for full disclosure, I actually told Dale that day. I was not only lucky to be short from, I remember I had shown this chart here, and I got short from, I had said that my target is 161.8, which was 5,835. So I was short from there, but I was also lucky. I was monitoring at this retracement when the tumble started. I was also lucky to book plenty of profits near the 61.8 because it was completely overblown and some kind of a retracement, you know, would have happened. And as I told to Dale that day, otherwise I wouldn't be repeating it because, you know, somebody can easily say that, you know, you're saying what you want afterwards, but, you know, Dale is aware of that. I actually resorted this market 5 minutes before it closed because I thought that the retracement was quite a lot. I thought that people will have enough time to digest this kind of a huge move during the weekend, and I thought that we will see at least one more bout of selling pressure to start the week because some people would be sitting over their positions, some of them in great profit, because let's be honest, there are a lot of people that have been buying into this bubble and have been buying a lot lower, so they have a lot of profits. Those people as well would be worried, like, oh, you know, I've had a great run, I've made, you know, so much profit. Yeah, okay, I lost 2-3%, let's say, on a Friday, but I'm still in good profit. Is this perhaps, you know, the area that I should be looking to book some? So, you know, I expected after the retracement that we had that we're going to see some fresh selling pressure on a Monday. So I re-established my positions just before we closed. And I'm seeing today another retest of the 61.8. I see that the market is holding for the time being. For me, it's important, this almost confluence of the channel, the ascending channel and the 61.8. I really want to see what's going to happen here. I'm not willing to lose any of my profits on the move up, so I'm gonna bail out if we go back to my entry point and then monitor what happens from there. But I mean, this is a huge move. In healthy markets, these moves do not come on a solo day like it came here. But this is not a very healthy market. I mean, this is not a market that's been directed mostly by the average trader that makes educated decisions. So I'm really worried about it. And unless I see the channel break to the downside, I wouldn't jump into, saying that, okay, this is a broken market, expect a huge retracements or whatever. If it was any other kind of market than a US stocks, I would definitely tell you. If this was an FX pair, for example, if this was such a kind of move like we saw in the cable, I mean, I tweeted about it as well. I rebought cable at a retest of 127.70 because it was the lows here and the low here, etc., without even thinking about it, because this is an FX pair. I mean, it works a little bit more with traders' logic in mind. I mean, it's a more let's say normal market. But with US stocks, you really need to be careful. I mean, it wouldn't surprise me. I'm the first person that has been looking, for reversals, because I think that on the long term, US stocks are going to prove, and everybody's going to be looking, soon enough. I don't know if it's going to be in 3 months, in 6 months, if it's going to be in 1 week or in 1 year from now, and he's going to be saying, oh yes, the bubble crash of 2017, for example. And everybody's going to consider it, a fact then, as we consider now the 2007, 2008, and the 1999, 2000 valuations, to be a joke. But that's not certain that's going to happen from here. I mean, these irrational markets can easily provide, a short correction, and then we can break to new highs. Make more irrational moves to the upside before actually imploding. So you really need to be careful. I mean, if you were already short, that's great. If you're not, this is not the place to be shorting where we currently are, because, we have plenty of levels of support down here.
Yeah, that's a good point, Luca, that it's rotation. Yeah. And they came out of the techs and they bought the banks, had a good rebound. Oils had a good rebound. So, you're right. But I'll tell you something. Have you ever heard this one, Luca? When I consider the NASDAQ the troops, all right? They've been leading the charge. When the troops retreat, eventually the generals get slaughtered. So I think we're into this summer period where there could be some vulnerability. Actually, Steve, besides that 2360 level in the S&P, I've seen some counts that could take the S&Ps in a wave 4 down to about 22.5 and then rally to new highs. So that's kind of my bias here in the summer.
S&P, because I know that more people are trading it. Listen,
they'll go to your blue moving average down there.
Yes, the 200 here.
Yeah,
and this is also a confluence of previous zone. Yeah, 2,280 roughly at the moment, let's say.
Right.
But there is, I mean, I also see potential ascending wedge here, but we still haven't seen any follow through. For me, Friday's candle, from a candlestick perspective, is important because this is an outside day. It's an outside spinning top, actually. It's a spinning top that engulfed the whole
weekly
price action since the previous Friday.
Right.
So this can be an early indication of a reversal here as well, the possible ascending wedge as well. But let's be honest, until we at least break this level, which is 2,402, 3, 400, let's call it, round, there is absolutely nothing that somebody can be based to say, oh, this, by the way, this high that we briefly penetrated intraday was also the 161.8 of this 1.5 day move lower. So, we had a series of resistances up here that momentarily seem to have worked, but let's see, are we going to get any follow through? Even if we get, unless we break to 2,400, there is nothing to see here. Nothing to see here. I mean, let's look at the big picture. Let me zoom out. I have this pitchfork with its 200 extensions. Look at it. I mean, we've been more overbought in the past than we currently are, having to do with the pitchfork, I mean. We do have RSI divergence here, which I also pay attention to. And we are definitely overvalued like hell. But, how many times could we have said that for this whole run that started back in 2009 until today? Plenty of times.
Yeah.
So, I'm staying away from calling tops. I am looking for reversals. And you know, the Nasdaq reversal did pay out. The first time I left at break even. This second time I did, you know, some very nice profit taking there, and I'm quite happy with it. But I still tell you, if you ask me, is this, you know, the top of the market? I would say that statistically speaking, it's less likely that it isn't. It is more likely that it isn't. I mean, it's less likely that it is. So be very careful.
Okay, we have Ash asking you about silver, buddy. And,
yes.
And since,
silver, as I said before, with Blake,
since our silver maven isn't here, you have to go over it, and I'll be right back. Okay.
Yeah, sure. So silver, those are the zones I was always looking at silver. Let's extend them. I had 2 entry positions in silver. My average was at around 16.20 little. I don't even remember the little. So I bailed out half of my position when we saw this doji, almost a shooting star actually, up here, because it's entired. I didn't expect to get a rejection from the channel support so fast, but then we got the 61.8. I had already said back then that in my opinion there is very little chance that silver is also going to surpass this little zone at 1780 before at least retracing part of the gains, and we didn't even reach that. We came close to it, but we didn't. When on Friday we broke below the ascending channel and closed right on the support, I really stopped believing that it's going to rebound for one more time, so I bailed out for the other half. And the question is probably now, okay, where do I look for the next support? The zones I've drawn have worked quite nicely, so I'm going to stick with them, and we can also draw a new fib now that we are definitely in a correction. So the zone I'm looking is 1670. 1670 and change is the average of the zone, so that's a zone. But let's see what the fibs tell us as well, because we might get a confluence there. Okay, and the 61.8 is that at 1668. So I would say that I would expect some kind of a reaction between 1660 and 1680, something like that. So I would be looking for this zone. This was a possibility that I had drawn up here. As you see, this chart has remained as it was. A retest of 1720 and perhaps a rebound. Obviously, we are moving to the next support zone. So now the next scenario is this. A retest of this zone and higher. So this is the game plan for now. And unless I see, a sign that we're bottoming out, I'm not going to be involved again. I don't want to give back, the gains I made when I don't have high conviction. So if the market actually gives us a good reversal signal, I'm going to take advantage of it. If not, I'm fine with that. I mean, it doesn't mean because you traded, an instrument successfully once that you really need to get involved with it again. So I'm monitoring silver. I like silver on the upside for a longer term position, but I'm only going to get involved again if I see a convincing reversal that will tell me that this move was, one leg, then we have a corrective move and we're looking for at least one leg higher, if not more than that. So I'll let you know, as always, if I'm involved again with this market. Now having to do with oil, because we had a discussion in the chat room as well. We had drawn this a couple of days ago in face. We had made this discussion. I remember I was telling Blake that, I see some signs of a bottoming here, and, as long as we're holding the 78.6, I believe that a rebound of some kind may come, but, we remain bearish until, until or unless we break above 49. Today, after a spinning top and another, more or less, it's a hammer, the other one, after 2 pin bars, more or less, we see some upside move. So that's the beginning of it. Now, will we get more and much more? I can't be certain of that, but I know that the first resistance we're going to find on our way up is almost 47, 46.90. We had this high here, some weak close here, and then we are heading to 49. So currently being short, as I said on, what was it, Thursday and Friday, currently being short, the risk reward, I don't see it being here. I'm not telling you that, you know, I would be long, and I'm not, but I'm telling you that a rebound of some kind is remains likely. So that's what I see.
You know, under that 44 level with a 55 high, starting to look like a head and shoulders top, and then on the weekly, you would put in a right shoulder about $35 or $36. So
you are right, and let's have a look at the weekly since you mentioned
the daily's starting to look like a head and shoulders top, and the weekly to put in a right shoulder, if you go to the left of the head, it would come in lower, like around.
You're right, and thanks for mentioning it, because there is also one more thing.
That's my job.
Indeed, and there's one more thing I'm watching on the weekly. It's this channel actually. So we also have this channel. We actually have two channels which more or less confluenced last week at 44.50, call it roughly. Yeah. So, you know, on the weekly chart, yeah, it is. But if you look at it like this in the weekly, it does look bearish, but no.
It could hold there. Yeah, it could hold there.
Yes, exactly. No real irreversible technical damage has been done yet.
So, it kind of makes sense if we get a S&P correction. That oil also that people are trying to rotate in doesn't work for them either. And, you know, I'm just, you know what I think is really going to be the fooler for people is oil breaking after a little pop and Canada USD not rallying but declining. I think that's going to, everyone's going to be saying, how can Canada be going down with crude going down? And I think that's a possibility. So also, if the stock market's going down, that should lift it too, right? So Canada could have everything going for it, and you know, maybe they can get one more rally back up to 5.5 if that happens. But it sure looks vulnerable to me. And you know, we go to 33, like you're saying, that could be a head and shoulders developing, and then you go all the way down to 130. That could be a neckline. 130 from 138 gives some of FA's long-term objectives of 122 on the long-term.
Now that you mentioned it, let's make a top-down inspection of USD CAD. I think Gregor has done that.
No, Sir Pinkert's laying them all out there right now, man.
Exactly. So what I was monitoring with the ascend in USD CAD since quite early was this ascending pitchfork as well, which had worked wonderfully. Yeah. And after seeing this impulsive reversal with this huge candle that we got up there in January there. By the way, Dale, another example of seasonality. Look
beginning of the month.
Yes. Exactly. USD CAD is another pair that shows that it actually topped at the beginning of the year, or bottomed in other cases, right?
Yeah.
So it topped there at the beginning of the year, and then never ever penetrated above that top for the rest of the year. Although it retraced somewhat, it didn't. So what I'm trying to say here is the following: we had a clearly impulsive move lower. You can even see it on a weekly chart. 1, 2, 3, 4, 5. A clearly impulsive, extremely strong move to the downside. I do not believe, look at this correction. I know it's prolonged in time, but it is overlapping, slow, choppy. I mean, which of the two looks like an impulsive move to you? This one or this one?
Yeah, you mean the one with a million overlaps?
Exactly, or the one that went without taking a breather from 146 down to 124.
Yeah,
you know what I mean?
In 2.5 weeks, and for 3.5 months, all we've done is correct half of it, really. Yeah, it's pretty obvious.
This is a weekly chart, actually.
And plus the positioning is wrong.
Yeah.
Wrong.
So if you ask me, if we take a top-down analysis and we see this chart, and I don't even know what the hell it is, and you ask me, okay, where is the next move? I find it very hard to believe that now we're going to see, after all this thing, an impulsive move higher. I find it very hard to believe that. Anything can happen in the markets, but where are the best odds? In my opinion, lower. So even if I look at the weekly chart in USD CAD, I do believe that this thing is going to go lower. And looking at the very, very short term, this is very weak. This is very weak. We've been saying that since last week. Like,
so maybe the pound CAD is a better short over the Euro CAD because of relative weakness of the pound compared to the Euro still having some
if
relative
you did
strength.
it prior to the elections, definitely, there's no question about it. Perhaps even now. Since you mentioned it, let's have a look at it. What is worrying about the pound CAD is the fact that we're penetrating this. You remember, actually this is a very old, I mean, those are, when I had drawn them back then, I think I tweeted from the ForexAnalytix account back then. I was looking at the possibility of a break higher here or a break down to this zone. Actually, neither of that happened. We started chopping around, and we ended up having the break off the descending. I had also written this, that this was a false break here because we gapped lower from the previous, from the zone that made the previous lows. And then we actually had the break higher. We had an acceleration. I was monitoring at this zone for resistance. We actually penetrated above it. And now on the way down, I was monitoring at this ascending trend line. And we seem to be breaking below it. Does that seem that this thing is going to be completely destroyed? No, it doesn't. But it's definitely a bearish signal. And even if we say that this move higher was impulsive, which I'm not so sure about it. I can see corrective interpretations as well. But even if that's the case, if the move higher was impulsive and now we have a corrective move lower, then I would still probably expect something like we can go lower. We can go at 168.50 to have two equal legs. So yes, pound CAD is weak. It can go lower, but the place to short it with conviction, which I didn't do, probably because I wasn't watching it those days, was this place. I didn't draw this line afterwards, this area afterwards. It was there, this retest. We had a move lower, then A, B, C, retest of the zone, which was also the low here. It was also low here, low there, sorry, high here, high here, high here. If you go further back, a low here, a high there. So the high conviction short in the pound CAD was this retest, and probably not the break below the descending line. So if you told me that you're going short this, I wouldn't be telling you that you're nuts, but I would be really wondering what your risk reward is.
Okay. So really CAD's the key to a lot of these things here.
Very true, very true. Now having to do with the pound and what we're monitoring here, things are very obvious. We had said it since the previous week as well. I don't think that there is a high chance of not testing this confluence down here. The 200 DMA and the broken triangle. So I think that we should see a test of 125.80 before even considering a rebound. So this is the area we'll be looking. Obviously, if you're not short already, or if you didn't short the rebound on Friday, then the question goes again, okay, what is your risk reward now for entering short? It might work. Sure, it might work.
I'll be back in a couple. George Perks is in the house. We'll start the interview in 5 minutes.
Oh,
Hi,
yes.
George. Hi, George. Thanks for dropping in. I'll be back in 5.
Okay, perfect. So that means that we still have 5 minutes. So what do you want to check, guys and girls? Let me see. Let me go back to questions. USD yen. Yes, thank you for reminding me, actually. This is what I see in USD yen. Look, I see two different things here. First of all, we had the descending channel. It was working perfectly nicely until we got this break above it. Then we retreated back below it. Now I see a possibility of a descending wedge. Two things are for sure. We had said it since the previous week. One, you cannot turn bullish this pair unless we break above 112 and hold it. So unless we close above this area. I mean, there is no chance I can turn bullish USD yen unless we close above 112. Second of all, I'm also monitoring this wedge. If we see a decisive break above this wedge, for example, another move lower, and then let's say that's not my main scenario, but let's say we see something like this, and then a strong move higher, it's going to add to my conviction that a break above 112 will be of significance. I'm not saying that I'm going to go long on a break of the wedge, but if I see a break of the wedge with momentum and conviction, it is going to make the break above 112 even more important in my view. Until then, there are targets. We have a confluence actually, which is the 108 level. Why? Because it is the previous low here, and it is also the equality target of this move lower. So like A, B, C, for example. So a double bottom, let's call it, is in the cards. I mean, we have strong support down there. So if you ask me if I believe that we're going to retest 112 or 18 first, definitely it's going to be 18. But I'm not involved with this at the moment, and I don't wish to be involved until we see something that convinces me that it wants to move stronger, in a stronger manner, because lately we've been chopping, some correlations have broken down with the USD yen. So I'm not involved and not looking to be involved imminently with this market. Hey Steve, Aussie is still strong today. Not sure if it can sustain levels above. Yes, okay, let's have a look at Aussie. Listen, there was a chance for Aussie topping below, as long as we stay below this confluence of this zone and the 61.8, and there still is. We also had the quality target of the first leg up and the second leg up, which we saw at 75.60, call it roughly, but the Aussie is still holding the important zone of 75. As long as we remain above 75, you know, there is no bearish argument to be made in the short term. I repeat, in the short term. I've said quite a few weeks ago that after we saw the initial rebound, that I don't see clear conviction in Aussie and Kiwi, in the medium term I mean, and since I'd rather be aligned there, I will not get involved. I ended up getting involved with Kiwi because I like the fact that we were overbought a lot and we had the confluence of resistances here. But still, this is a trade with a very, very, very short and tight risk for me. I'm now a little bit in the money. I'm risking my entries at 72.20 almost, I think a couple of pips below that. The high was just 5-6 pips higher, whatever the hell it was. My stop loss is just above the 61.8. So I'm risking almost nothing. So I will stay with it. but we're holding the ascending channel. We remain constructive. So there is still a risk reward for somebody to be short. I mean, we can be seeing a slow start and then an acceleration. But look at it this way. Yes, mate. You want to start? Yes, sure.
Yeah,
Aussie Kiwi is still not very clean in comparison to other tickers anyhow. So we will go over the rest of the questions tomorrow so Dale can start the interview. Thank you very much for your wishes. Dale, have a wonderful interview. I will be listening, of course, as always.
Well, we're very lucky to have George Perks with us. George, you're self-muted if you could hear me. If you could turn the mute off.
Hey, Dale, how are you?
There you are, George. Thank you so much for joining us today and addressing our community on a busy day. I just want to, I'm going to be showing your, I think it's a blog post that you have here, buddy. Let's see. I'm going to take the controls here. Okay. I like the sign, gratitude. George, you can't be depressed if you could find one thing to be grateful for.
I totally agree. That's a billboard that's in the Bronx, visible from the Metro North line. I used to ride past that every day on the way to work when I was still up in New York, and it's a great message. I don't know who put that up, but it's awesome. Yeah,
and why is the E backwards? Any idea?
I have no idea. All I know is that that's a billboard in the Bronx.
Okay. Well, George, just want to introduce you quickly to the community. You can follow George, and I recommend it. He has excellent insights into the macro. He's a macro strategist at Bespoke Investment, so you could follow him on Twitter @Perks, and then his blog will come up. And I do want to talk about a little bit later what you were discussing here, Nehru, which I'm not familiar with at all. But why don't we start it off with what everyone's talking about, and that's the dramatic sell-off in the FANG stocks on Friday, George. Is it a harbinger that we're finally going to see some type of retrenchment pullback in the market? What are you telling your people at Bespoke?
Yeah, so I think it's important to remember that two things. First, that the U.S. tech sector had sort of led globally for quite some time and had really gone parabolic. As of last week, we had a 14-week RSI reading on the NASDAQ on the NASDAQ composite that was, sort of the 95th percentile of historical readings. You pretty much had to go back to the tech bubble to see something comparable. And we took a look at what that meant for the market, and it's not a good indicator of what comes next. And in fact, in similar, high weekly RSI readings for the NASDAQ, you tended to see actually outperformance over the subsequent, 3 months, which is counterintuitive, but speaks to this idea that, markets do tend to trend, and high momentum to the upside or downside doesn't necessarily mean that, you're going to see a reversal. So something to keep in mind in any asset, that stuff does tend to trend more than you think.
You mean like Bitcoin? You never know how long a rubber band could stretch before it snaps back?
I think in almost any market we can say definitively, well, it can only go so far, but how far is so far is just, it's almost impossible to know. So looking at it historically, speaking to the current sell-off, we came into last Friday with really overbought conditions in the NASDAQ, and sometimes that led to decent-sized sell-offs. In the case of the let me pull up the specific data we have here so I can read it off to your listeners. But
what really struck me, George, is not that we had a sell-off, but the velocity of it, and that within 8 or 10 seconds, Amazon lost 10% of its market cap. And I'm wondering what your view is. There have been a lot of comments over the last few years that market structure isn't as strong as it used to be because we don't have market makers. They took away the incentive when they decimalized it, and we're being run by the machines. And it could be a harbinger of all this. If there was ever a program in the spiders, something like that could repeat in the spiders. And did that bother you at all that it was
no.
break? No?
No. I mean, okay. So the market structure stuff is sort of, I would talk with the market structure stuff as sort of independent from long-term returns, right? I don't think the market structure stuff has any impact on long-term returns other than lowering costs for typical investors, especially small investors. So you're absolutely correct that market makers are having a harder time stepping in, especially in something like equities because of balance sheet constraints and how a variety of new regulation has treated those in terms of capital cost. That said, you know, that's a valid observation, but I think that if you're an individual investor, that means that you may have to alter your trading strategy in terms of high frequency, you know, strategies. But for the average person, that's an unmitigated good thing. And the reason for that is that the average person is going to be long the equity market in size for 30, 40 years. And day-to-day moves, minute-to-minute moves do not matter. They don't matter, right?
Does stop losses matter, George?
Well, it depends on your trading strategy. Again, for the average person, stop losses don't matter. I realize
because they don't use them, right? Because they don't use them.
They shouldn't, right? For this audience now, the folks listening, it may be a totally different story, and I totally understand that. Higher frequency, active individuals, it's a different story. But for the average person, the idea that liquidity has gone down means that the cost of liquidity has also gone down, right? It's an incentive thing. And, you know, I think that's an unmitigated good thing.
The glass is half full.
I would say so, yes. Now, for active individual investors, if you are leaving stop losses that are automatically triggered, if you're not doing limit stops, you're just doing market stops, you're gonna get hit. You know, and we would tell anybody that they should be using limit stops, no matter what kind of investor they are, because you know this idea of flash crashes, however you define flash, whether it's a couple days, a couple hours, a couple minutes, a couple seconds. We like to think that it's all because of the computers, but this sort of activity did happen previously, right? These sort of departures from fair value due to liquidity concerns. I mean, you know, there's a little shop called Long-Term Capital Management that blew up for exactly that reason. They were ultimately correct in most of their trades, but they couldn't hold them because the market moved against them in an illiquid way. That was in the late 1990s, and the markets they were dealing in were not totally automated, were not, you know, ETF driven. They were individual people on phones usually trading bonds. So, you know,
with a green Quotron machine on their desk.
Well, you know, whatever. 1987, portfolio insurance drove a lot of the crash in 1987, and that was in large part automated. But the market wasn't massively long ETFs, passive investment vehicles, that sort of thing. It was almost entirely humans behind desk making decisions. So, you know, I just
Point well taken.
Yeah. Now again, for individual investors that are active in the markets from day to day, that are using leverage to manage to juice volatility and, you know, approach investing that way, which is a totally valid thing to do. You know, when I say the average person doesn't behave that way, I don't mean all people should behave that way. I just mean that, you know,
we know what you mean.
Yeah. So I don't want to cast aspersions.
No, we know what you mean, because a lot of people were better off that. You know, if they just went to sleep during Brexit, and for sure if they were asleep after the evening of the election win for President Trump, they were better off not being up that night and seeing it lock limit down, better off waking up the next day. And, you know, I'd like to shift it a little bit, George. You know, a lot of people, emerging markets were out of favor for years during a strong dollar period, and you know, a lot of our work shows that the dollar's in a pretty critical area that it has to hold. Do you take the dollar into consideration as to where you're going to invest? If you think the dollar's going to be weaker, that's going to favor multinationals over the Russell, seems to do better with a stronger dollar?
Yeah, absolutely. So we've done a lot of work on this, and we actually have an index of the Russell 1000 that we break into companies with high international exposure. So that's companies that derive more than half their revenues from overseas. Generally overseas, sometimes that means outside the United States, sometimes that means outside of North America, but generally speaking, that means ex-US. The other side of that index is the percentage of companies that derive greater than 90% of their revenues from the United States. So we split that into internationals and domestics respectively. Internationals more than half their revenue overseas, domestics more than 90% of revenues from the United States. And one of the things that we'll tend to see is during periods of strong dollar, the domestics will outperform quite significantly. So because those domestic revenues aren't sensitive directly, they're second order effects, but they aren't sensitive directly to the dollar, whereas the rising dollar reduces, just forget about what it's doing in local currency. If it's unchanged in local currency, it goes down in US dollar terms for internationals if they have a high revenue exposure. So what we found is that there is a decent correlation between the spread of performance for those two sets of stocks and the price of the US dollar. And what we've seen this year is we've seen a lot of the sort of domestic type trades, concentrations in energy, in industrials, in consumer discretionary. Those types of trades have really underperformed versus their strong performance late in 2016, because in 2017 the dollar really hasn't done much other than go down, right?
What do you make out of a lot of the Trump trade being unwound almost back to the levels they were at in November before the recent bounce in the bank shares?
I
the bonds are trying to rally back to where they were before the election result. What do you make of that?
I think we all love narratives, and I think the narrative of, okay, we've got a unified legislature and presidency in terms of party, and those folks are going to be likely inclined to cut taxes and disregard the deficit. That was sort of a great narrative that the market really liked, and it played out in a big way. And now we're sort of, supporting that narrative was this, this very synchronized acceleration in global activity that dates back to the middle of last year. You had China, Japan, Europe, the U.S., EMX China, all take off at the same time, and all sort of head upwards within their cycles simultaneously, which is something we hadn't seen since like 2011. So that as well supported this narrative of short the bonds, long the dollar, long corporate activity, S&P 500, global equities, however you describe it. What we're seeing now is, especially led by U.S. data, a reversion of that acceleration in global activity that dates back to last year. The U.S. Economic Surprise Index has led all economic surprise indices lower. Everything's sort of rolled over and is missing estimates to a slightly lesser degree in Europe, but true across all major economies. On top of the fact that the Trump administration has delivered no significant legislative wins so far. And when I say no, I mean none.
You think they will?
Well, I would be inclined towards no, but I think you can make the case that they'll do something on taxes.
Okay.
At the end of the day, though, the pricing that a variety of assets demonstrated, in late Q4, early Q1 of this year required big substantive change right away. And I think it's fair to say that that's not happening, right? We may get tax reform in some way, shape, or form. We may get the AHCA passed in some way, shape, or form. We may get some sort of infrastructure spending, but it's not going to look revolutionary in any way, shape, or form. It is not going to, right? We know that for a fact. So it makes sense then that a lot of these assets would be reverting towards the sort of levels that prevailed in 2016, maybe 2015, less aggressive expectations around or price levels for inflation, less aggressive yield on the 10-year, less aggressive dollar valuation, so on and so forth. So, that all kind of makes perfect sense from a policy perspective.
All right, you brought up the oils. You have a view on any commodity plays, oil being depressed, every OPEC agreement, we get some nice jawboning. We've been stuck in a range. We're threatening the bottom of the range in WTI. Gold looked like it was trying to break out a week ago. They turned the gold back. Anything you're seeing in the commodity basic materials area that looks hopeful or could be a good play because it's undervalued?
Yeah, I would take these three in a row. So I'd start with oil and then talk industrial metals and then talk precious metals. So for oil itself, the thing that I've noticed so far this year is that we are just trading in such an emotional, temperamental way with regards to OPEC. You know, a good outcome gets priced in ahead of every OPEC chatter, and then it gets priced out quickly afterwards, and people are just swinging it back and forth in that respect. Technicals have played a substantial role as well, but really it's about how people are getting positioned ahead of and out of OPEC chatter. And that's hard to trade if you're not, you know, keeping a close eye on everything that comes out of a variety of different countries. Taking a step back for oil, at the end of the day, we are not going to see $100 oil anytime soon. There has been a really big repricing, and I'm sure everyone who's you know, listening right now is aware that the swing producer is no longer OPEC, right? The swing producer is somewhere in the Permian Basin. Yeah. And as long as that's true and that oil supply is more elastic than it has been in the past, you're going to have suppressed oil prices. Now, the caveat to that is the fact that the marginal supply may be very price elastic, but the total supply is still very inelastic. So when you're talking about mega projects in non-OPEC producers, non-OPEC, non-US producers, when you're talking about offshore production, you're talking about extremely large CapEx requirements to maintain output, let alone develop new output. And demand has been fairly consistently growing. So eventually we're going to get to a place where the swing producer is no longer in the shale patch because the shale patch's capacity can't make up for the consumption of offshore and non-OPEC, non-US capacity through consumption and the consumption of the investment.
That could take a while to develop. We're talking like we could be talking years, can't we?
Yeah, no, absolutely. It's not in the foreseeable future. That is a 1 to 5 year story. If we see really strong demand growth, it could come as soon as a year. If we see slower demand growth, you know, it could come further out. But at the end of the day, the shale patch will not be supreme forever. It is right now. So with that in mind, as long as the shale patch is the swing producer, $100 oil isn't happening anytime soon. And it's going to be a question of how fast the fields outside of OPEC and outside of U.S. shale patch are consumed through natural attrition. That's going to be the function of when we switch regimes again. So for WTI, the way I see it is trades very emotionally. If you're using a pure technical strategy, you can do okay. If you're headline watching OPEC all day long every day, you can do okay. Just by sort of being contrarian and saying, okay, market's going to get bullish as we head into OPEC and then bearish out of it. If you're sort of taking a longer-term view, it's really hard to figure out what the timing of that next rebalance is going to be, and I don't have a strong view beyond a couple years out, and who knows beyond that. So that's how I look at oil.
Okay, let's go to the gold and the precious metals. I was taught, George, I don't know if you agree with me, but as a commodity trader, I was schooled that the shares should lead the way of the underlying commodity, and the shares, even when gold was having on the verge of a major breakout that everyone's looking at, even like Carter Worth, everyone's showing it like a 20-year symmetrical triangle, the shares have been underperforming the gold. So where's your head at on gold in here?
Yeah, so I don't look super closely at miners versus underlying commodity for the precious metals. My sort of approach to precious metals is that they are essentially a real yield targeted instrument. So gold is essentially a 2-year real yield instrument, similar to 2-year tips. And if real yields are headed up, gold is going to underperform, and vice versa. Because you're talking about a dollar interest rate relationship there is an inverse relationship.
You're talking about opportunity costs. Like when it was really smoking when we were moving towards negative yields last year.
Exactly.
So okay.
Yeah. So if real U.S. dollar yields are dropping, gold should be rallying, right? It's the same thing as the two-year tip tip bond. Well, it's a note, but you know what I mean. Roughly, I mean, you can change the time frame on that, but the general feeling is something close to that.
Do you like them? Do you like them, or is it an avoid for you?
So I think to have a view on gold, you sort of have to take this U.S. interest rate view and sort of a U.S. dollar view as well. I think the dollar has gotten really cheap against interest rate differentials. So if you were just looking at two-year yield differentials, and I like looking at swaps and the Bloomberg U.S. dollar index, that's sort of my go-to. The dollar is like 3 to 4% cheap right now, and there's not a lot of justification to sell it off further. And typically U.S. interest rate, or the interest rate differential, leads the dollar itself. So it's strange to see the dollar, you know, potentially leading a move in interest rates as opposed to the other way around. With that in mind, I mean, I think you could take the same approach to gold. You know, I think gold right now is not really attractive or unattractive. I would probably be biased against it because I'm slightly biased towards the U.S. dollar being a little bit too weak. But I don't have an extremely strong view on it.
Okay, well, since you're talking about yield spreads, it's Fed week. Give us how you're wrapping your head around what the Fed is doing, what impact it's going to have on different markets. Will a Fed rate hike continue to flatten the yield curve? If they go too far, could it invert?
So I don't think we're anywhere close to a curve inversion. You know, it would be strange to not have one ahead of the next recession because that is an excellent recession indicator. But we're currently, what, 110 bips or 100 bips on 2s10s?
Right.
I can't remember off the top of my head. That's a lot. I mean, that's 4 rate hikes without the 10-year moving up at all, right? Which, you know, we'll eventually have to start talking about curve inversion, but we're so far away from it. It's not something I need to worry about.
A few years, you think?
I have no idea.
Okay.
You know, because what you have to do is you have to forecast not only the
direction of rates, but the curve.
Well, you have to have a forecast for both the 10-year and for short rates. I think if the Fed hiked 4 more times, the 10-year would probably rally a bit. The 10-year yield would go up a bit, right? So at least a little bit. I don't know. Currently, well, you know, I don't think we need to worry about curve inversion right now. It's a conversation for a later day. How
about the fact that this might be a failing rally in the bonds? I use TLT as a proxy. We topped last year, you know, I'm a technician and left a very rare formation, an island top formation. And then on the last interest rate increase, we've had this rally. We're retracing 50% or so. I think there could be more left. TLT has a gap around 130, but I don't think we're going to make new highs in the bonds, which means I don't think we're going to take out the low yield. Maybe we trade under 2, but would you view if the bonds got under 2 as it being selling? If you own bonds, you should sell them, get out of them, and move into a different instrument?
Yeah, I think sub 2% on the 30-year yield, for instance, would be, I mean, yeah. Oh, okay, so you were talking TLT, so that's the long end.
Oh, yeah. It's 20.
10-year, yeah, 10 or 30 below 2% is too low. The economy is not bad, right? Like, I know I said earlier, okay, well, economic surprise is rolling over and the U.S. is leading that, and like that's a good reason to sort of fade the Trump narrative, or that's been a good reason to fade the Trump narrative. Okay, fine, but like the economy's not going to fall apart. You know, barring some massive shock that we can't predict. So, for instance, an asteroid falling or something like that, right? One of these things that there is no way to model for, that could tip us into recession. There's no question.
A conflict, a hot war in Korea.
Sure, something like that. Yeah, absolutely. But if you're looking at economic inputs and outputs only, and you're sort of saying, okay, well, we can't model those true black swan. Let's forget about it. So if you do that, I mean, I think it's easy to make the case that we don't go into a recession before the end of 2019. You know, I don't see the imbalances in the U.S. economy that would require a recession to cure, and that sort of, you know, that is what you need. And, you know,
You don't think the fact that housing prices have recovered above the 2008 peaks is an imbalance?
No, I don't, because they're not moving drastically out of sync with rents, right? If you know, that doesn't mean that rents are inherently right, but if housing prices are moving up roughly in line with rents, which is something that the Fed looks at quite closely post 2007, 2008.
That's interesting. If
that's the case, then okay, well, rents are too high. That means we have insufficient. That's a supply side problem. That's not a demand side problem. That means CapEx is too low, right? Like fixed investment in housing is too low, and that's true. If you look at fixed investment in housing relative to GDP over the last, since World War II, we are still super low, and we're super low in aggregate fixed investment relative to GDP, and we're historically low in aggregate government plus private net fixed investment, so backing out depreciation. Extraordinarily low versus history. So, with all that being the case, it's really hard to have a business cycle roll over if you haven't built too much of something, right? That is what a business cycle is
Just we had too many malls.
We have
too much oil, too many malls.
There are individual sectors that have had supply corrections, and oil is a great example. But there is nothing that's large enough relative to the economy that's seen overinvestment go to the point where, okay, well, it's too big. If malls are overbuilt and consumer spending rolls over, then yeah, that's a big problem. But like we saw with oil, if malls are overbuilt and we have a supply contraction in the amount of available real estate, but aggregate consumer demand is holding up, that's just shifting revenues between sectors. That's not actually, destroying economic growth. So, I think that's really important to keep in mind. Like, there's no reason to think that the consumer is going to roll over. And so if you're purely seeing, micro-scale sectoral imbalances in, first it was first it was oil, now maybe we'll see malls, whatever the case may be, the economy can digest that without going into a recession. Like that's really important to understand, that the economy is way more versatile than, oh, well, something's contracting, and that means we're going to go into recession. No.
Yeah, we're not over-leveraged in anything to the same degree we were,
We are not. The Fed released its flow of funds report last week, and, it's a little bit improper to scale by GDP, but it's a convenient way to do it. Aggregate domestic all sectors debt, so that's financial sectors as well as households, as well as businesses, everyone. Aggregate domestic sector debt, it includes government, it includes state and local government, has continued to decline. It made new lows relative to GDP in Q1. So, I have a really hard time digesting this.
So most of your clients, nothing's changed. Stay the course, sanguine, no problems, or even a potential recession for a few years. Can you I know this might be outside your wheelhouse. What do you think about this mania in cryptocurrency?
Okay, so I'm not a cryptocurrency expert, so I just want to usage with that. It's not really my ballywhack. But,
okay.
But
I figured it wasn't.
Yeah, but we do get questions on it. I do keep an eye on this space a little bit. Cryptocurrencies are not going to replace the traditional currencies, right? That's not going to happen, right? And there's a lot of reasons for that. The easiest to explain reason is the fact that any transaction into currency, so you're converting US dollar or euro or yen or Chinese yuan or any currency, if you're converting into cryptocurrency, you're leaving a paper trail. Like, governments can find that, right? So using it at a large economy-wide scale requires governments to say, okay, we're cool with this. Now, I get that people think that it's a great alternative for moving around currency in the dark, for moving around value in the dark. So, for instance, capital flows out of China, whatever. Keep in mind that relative to the size of total payments or total economic value exchange, that cryptocurrencies are still a rounding error. It's not an issue. If everyone decided en masse, okay, we're going to switch all of our economic activity to cryptocurrencies, first off, I think that'd be a bad idea because the supply is fixed, and fixed money supplies are horrible for economic growth. But
did you write a letter to Prime Minister Modi of India about that?
No, I didn't.
What do you think about that draconian move?
So that particular I would distinguish that move because what they're doing there is they are forcing a black economy, so like what is going on in cryptocurrencies, into the light. They did confiscate wealth effectively in doing it, but that you have to question whether that wealth was ever, you know, real wealth anyways, right? If you're doing transactions and accruing value outside of the government's ability to tax and the government's ability to keep an eye on you, you're asking for trouble. I know there are a lot of libertarian sort of leaning folks who would say, well, right, governments don't have a right to tax everything anyways, whatever. Okay, well, in the real world, like in reality, that's not how it works. If you're thumbing your nose at a government's ability to tax and a government's ability to keep an eye on what's going on in the economy, you're playing with fire, right? I mean, yeah, that's just the way the world works.
Good advice.
Ultimately, that the demonetization move by Modi will be very positive for the Indian economy. You know, there is so much demand, and they've got great demographics relative to the rest of the world, that I really think everything they could bring into the light of the formal economy, where people pay taxes and are subject to the same laws as everybody else, is a positive. You know, I don't think it's a bad thing. It did cause a demand shock in the short term, but it's something that will work itself out and ultimately be a very big positive in the long run.
Well, I want to take it back to the beginning of our interview, and the word is gratitude. I want to thank you, George, for, we covered so much here in such a short period of time, and, you know, you're so eloquent with your views and everything. I encourage people to follow George Perks, @Perks on Twitter, and at Bespoke Investment. Are you guys registered investment advisors?
Yeah, we're registered. We're registered investment advisors, and we also sell our research as well. So if you guys are interested in that, the website is bespokepremium.com. You can do a free two-week trial without a credit card just to see what we're all about. And if you have any questions or if you'd like to learn anything, our Twitter handle is @BespokeInvest, or you can talk to me @Perks. That's PEARKES.
Thank you for your time today, George, my trading warrior brother. I wish you the best rest of the year. Okay?
Thanks very much for having me on, Dale. I'll talk to you soon.
All right. Great, George. Bye. That's George Perks. Everyone thank George, and thank you, Face, and happy birthday, Steve, and thank you, Velu, and thank you, Blake Morrow, and thank you, everybody. I'll see everyone for Turnaround Tuesday. Have a great afternoon. Only a few weeks left in spring, maybe 1 week left in spring. Take it easy. And remember, don't just count your pips, count your blessings. Find something to be grateful for. I won't jerk any tears, tear jerker. But you're not going to be depressed if you have one thing that you're grateful for. So I'm grateful for this time that I have with the ForexAnalytix team and with all of you. Enjoy your day, and I'll see you for Turnaround Tuesday. Thank you, Dave, Nuno, Dave. See you guys, Glenn. Adios.